Welcome to this explainer. Today we're uncovering a massive blind spot in retirement planning. 5 specific taxes that seniors are legally not required to pay. Seriously, if you're 65 or older, there's a very good chance you're handing money over to the government right now that you simply don't owe. Why? Well, because the tax rules change yearly, new deductions open up, income thresholds shift, and the IRS won't automatically notify you when you suddenly qualify to stop paying.
So let's dive right into this, because you're likely paying taxes you legally don't have to, simply because nobody explained that these specific exemptions exist. It's not that you did anything wrong, it's just that the system relies on you knowing what to ask for. The default is always to charge you. So today, we're going to change your default setting from overpaying to perfectly optimized.
Here's our roadmap for today. We'll be moving quickly through federal Social Security tax, state taxes on benefits, slashing your property taxes, the Medicare IRMA surcharge, and finally, home sale capital gains. Let's get right to it.
Starting things off with Section 1, Federal Social Security Tax.
Most people just assume a portion of their check is naturally taxable and there's absolutely nothing they can do about it. But the reality is that the $25,000 threshold for single filers and $32,000 for married couples haven't changed since 1984. Meanwhile, decades of cost of living adjustments, or COLAs, mean your benefits are much larger today. So these modern inflation adjustments are suddenly pushing retirees who were literally never originally intended to pay this tax over those outdated thresholds. It makes up to 85% of their benefits taxable.
Now, there's a fascinating 2026 solution created by the new One Big Beautiful Bill Act. This legislation offers a massive senior bonus deduction right on top of your standard deduction. If you're a single filer with a modified adjusted gross income under $175,000, you get an extra $6,000 deduction. For joint filers under $250,000, it's a $12,000 deduction. This is a real game changer because it can lower your taxable income enough that many seniors with moderate incomes will suddenly owe absolutely zero federal tax on their Social Security benefits.
So what's the catch? Well, it applies to your 2025 tax return, which most people already filed back in April. If you filed without claiming this brand new deduction, you are leaving your own money on the table. But the good news is you can fix it. You just need to file an amended return using Form 1040X to claim it. The IRS processes these amendments within about 16 weeks, and they'll send that refund right back to you. Beyond that deduction, you want to keep yourself below those 1984 thresholds permanently through strategic income management. We're talking about things like withdrawing from a Roth IRA instead of a traditional IRA, since it doesn't count towards your combined income for Social Security taxation. You could also shift investments into tax-exempt municipal bonds. And importantly, timing really matters. Spreading large IRA distributions across multiple years rather than taking one massive lump sum prevents a single-year spike that temporarily pushes you into that taxable zone.
Moving right along to Section 2, State Taxes on Benefits.
As of 2026, 41 states don't tax Social Security at all, which is great. But if you happen to live in one of the 9 states that do tax benefits, places like Colorado, Connecticut, or Utah, please do not automatically assume you owe it. A quick check of your state's revenue website might reveal you qualify for hidden, unclaimed income-based exemptions. For instance, Colorado entirely exempts residents 65 and older. Connecticut exempts single filers making under $75,000 and married filers under $100,000. Utah uses a tax credit that effectively exempts lower-income retirees. Seriously, a single conversation with a taxpayer could uncover an exemption you've been missing for years.
Okay, let's look at Section 3, Slashing your property taxes.
This is where things get really shocking. Looking at 2026 AARP data, out of more than 9 million eligible seniors who qualify for property tax relief, only 8% actually apply for it. That means a staggering 92%, that's roughly 8.3 million eligible homeowners, are missing out and overpaying. And it's not because they don't qualify, it's simply because they never filed the required application.
The good news is nearly every state has at least one of 3 programs for senior homeowners. First, an exemption, which directly reduces the taxable assessed value of your home. Second, a freeze, which locks your assessment in place so it can never increase no matter what the housing market does. And third, a circuit breaker, acting as a safety net that limits the maximum percentage of your income that can be taxed. And the absolute best part, in states like Texas and Illinois, these are stackable. You can literally layer a homestead exemption on top of a senior exemption on top of a senior freeze for maximum savings that can reach well into the thousands annually. But here's the big catch. Absolutely none of this happens automatically. Your county assessor doesn't just wake up on your 65th birthday and graciously lower your bill. Your property tax will continue at the full rate indefinitely until you raise your hand. Depending on where you live, like taking advantage of expanded 2026 Texas homestead exemptions or New York's enhanced STAR program for incomes under $98,700, you just need to search that exact phrase online to find your local application. Many counties even let you apply digitally in just a few minutes.
Next up is Section 4, the Medicare IRMA surcharge. Now, IRMAA stands for Income-Related Monthly Adjustment Amount. It's a bit of a mouthful, but here's what it means for your wallet. If your 2024 income exceeded $13,000 as a single filer or $26,000 as a married couple, Medicare is currently charging you extra on top of your standard Part B premium. These surcharges range from an additional $69.90 all the way up to $443.30 per person. That means up to an incredible $887 extra per month for a couple, automatically deducted from your Social Security for the exact same Medicare coverage everyone else gets at the standard rate.
But here is a massive secret that most people paying this surcharge have never been told. The Social Security Administration actually uses your past tax returns, specifically from 2 years ago, to calculate your 2026 premiums. That means you might be paying a surcharge based on income from a job you've already retired from, or a property you've already sold. If you've experienced a qualifying life-changing event like retirement or a home sale, you can appeal the surcharge. You just download and file Form SSA-44. The process only takes a few weeks, and it can easily put $1,000 to $5,000 or more back into your budget on an annualized basis.
And finally, we arrive at Section 5, Home Sale Capital Gains. People so often assume that selling a home after a lifetime of appreciation is going to instantly trigger a crippling capital gains tax. But under current federal tax law, if you've lived in your primary residence for at least 2 of the last 5 years, you get a massive exclusion. Notice I said exclusion, not a deduction. That money is simply untaxable. For married couples, up to $500,000 of pure profit from the sale of your home is completely shielded from the IRS.
If you're a single filer, the exclusion is still an incredibly generous $250,000. And even if your profit exceeds those amounts, say you bought a home for $150,000 30 years ago and you sell it today for $600,000, as a single filer, you exclude the first $250,000. Any remaining profit beyond that is only subject to preferential long-term capital gains rates of 0, 15, or 20% depending on your income. It is never taxed at your much higher ordinary income rates. Which naturally leads us to what might be the ultimate legal loophole for passing down real estate to your loved ones, the stepped-up basis. This is an absolutely powerful estate planning benefit that most people just never properly utilize.
Here's how it completely eliminates taxes on generational wealth. Say you have a home bought decades ago for just $80,000, and it's worth $500,000 when it's inherited by your children. Their cost basis for capital gains purposes resets to that new $500,000 fair market value. It literally doesn't matter what you paid for it. This means if your heirs turn around and sell that house immediately for $500,000, the tax on a lifetime of real estate appreciation is exactly $0.
Wow, we have covered a lot of ground today. From amending your federal return for new deductions, to checking state exemptions, filing for property tax freezes, and appealing those sneaky Medicare surcharges. With thousands of dollars on the line across all 5 of these categories, the most important takeaway from this explainer is a question you really have to ask yourself today. Are you actively managing your tax exemptions, or are you just accepting the default bill the government hands you? Will you take the proactive steps to claim what's legally yours before the deadlines pass? The money is sitting right there. You just have to ask for it.